Good afternoon, everybody, and welcome to today's Lunch and Learn webinar. I'm Steve Mahoney. I am a mentor with the Greater Hartford chapter of SCORE. I'm with Kathleen Thompson, who is also with SCORE, and delighted to be joined by Stephen Taylor, who is a Vice President and Business Banking Officer with Liberty Bank. Stephen is going to be providing you the banker's perspective on small business lending. So Stephen, with that, I will turn it over to you.
Thank you, Steve. Can you hear me okay?
Yes, we can.
Excellent. Thank you. And good afternoon, everyone. Steve and Kathleen, thank you for allowing me to present to these lovely business owners today as it relates to small business lending and what banks typically look for. I've been in banking over 15 years now, and I've been a business banking officer with Liberty Bank going on 2 years. And I provide cash flow and lending options to help businesses sustain and grow, as well as partner with other lines of business within the bank, again, to help small businesses reach their financial goals. So I'll get right into it. Again, this is a small business overview on what banks look for as it relates to lending. So really today we're going to talk about the different financing options and sources that banks provide. Being a guarantor on a loan, factors to consider when evaluating financing options, as well as ways to improve your chances of getting a loan, including building strong personal and business credit history, keeping accurate business records, and understanding the 5 C's of credit. So a few different types of lending options, depending on the stage of your business. I do see, from my experience, a lot of startup businesses using either savings, gifts, and other informal type of loans. Obviously, that doesn't necessarily come from a lending institution, but term or installment loans. A lot of the time, it's if you're consolidating debt or if you're looking to purchase a piece of equipment for your business, you're looking more along the lines of a term or an installment loan. Lines of credit and credit cards. A lot of the time, lines of credit are used to cover expenses until some receivables may come in. It's good to have just to have in place, even if you're not using it, but also for other things such as payroll and working capital in general. There's also special purpose loans, as well as other financing options that I'll get into. So savings, gift, and informal loans. Again, as I mentioned, it's probably the #1 form of financing used by startups. Although, you know, a lot of banks will bring the SBA in, the Small Business Administration, if it's a startup business, to help support banks in regards to minimizing the risk, just because there's a lot more risk with startup businesses, just because there really isn't any financials to look at, just regarding cash flow and servicing the debt. Gifts may be counted as business capital, keep that in mind. But payments toward informal loans or investments by family, friends, or other individuals has to be a part of your cash flow. So term or installment loans, you're receiving funds once the loan is approved right away, as opposed to a line of credit where you're just drawing from a line of credit as needed, and you're only really responsible for what you draw from. But going back to a term or installment loan, you are getting that lump sum right away, and you're getting that responsibility of paying principal and interest right away as well for a set amount and period of time. So for example, it can be 4 years, 5 years, but typically term loans can go up to 7 years traditionally. As mentioned, it's repaid in installments with interest. And the purpose, again, as mentioned, the example I use on a term loan for equipment, it's really for financing purchases of assets in general. And it's secured by that asset. So if you were to get a truck for your business, for example, or any type of piece of equipment, that piece of equipment would be used as collateral and secured for that purchase. And then a new application would be required for additional funds if we were to look for, another piece of equipment, for example. Lines of credit, on the other hand, they're generally secured as well, but they're used to finance any business expenses. Typically, some banks do, some banks don't, but they require an annual credit review and renewal based on performance. So, a bank may ask for, an updated tax return a year or two down the line, just to make sure that that cash flow is still there. So that, if you were to utilize that line of credit, you can service the debt. There's really no lump sum disbursement at the opening of the line of credit, unless there was a specific need right at that time. But typically that line of credit is a separate account that's put to the side, and there if you need it, and if you don't need it and you don't use it, you don't owe anything. But monthly payments, once again, are based on the outstanding balance. So again, if there's no outstanding balance, there's no monthly payment. So business credit cards is a form of a line of credit. I'm sure most, if not all of you, are familiar with credit cards, but typically they do have a higher interest rate. But a lot of small business clients will take advantage of a business credit card. I'll give you an example. If you're getting gas in your company vehicle, for example, obviously that business credit card would give you more flexibility than a traditional line of credit. But then certain credit cards, have certain points and awards that you can get from utilizing it as well, that a lot of small businesses will take advantage of. It requires full payment of balance at the end of the grace period, so at the end of the month, to avoid paying interest. So if you utilize it and pay it back, the full balance by the end of the month, you won't owe any interest. If a balance falls into the next month, that's when you are responsible for paying interest on that balance. It's rarely ever reported to a consumer credit bureau, unless the account goes delinquent. And I've seen a lot of businesses as well put authorized users, so other employees on the credit card, based on that need, if they're traveling or whatever the case may be. So you can have various authorized users on the business credit card, such as employees. And then just going into some other financing options, financing inventory. So a loan secured by inventory, usually used to meet fluctuating seasonal cash needs. And then credit card sale loans are merchant cash advances. So for example, if you accept credit cards for your business, a merchant cash advance would provide you with a loan based on kind of what your monthly volume is. They'll give you a certain percent of that, for a loan. But it's upfront funds in exchange for a portion of future merchant processing revenues. So again, those credit card sales. And then, a lot of banks, as I mentioned, the SBA will work with government programs such as the SBA. So participating lenders make and service term loans and lines of credit for which the SBA extends a guarantee of repayment. And again, you'll see a lot of this with startup businesses, just because it's taking a lot more or less risk off of the bank. So the guarantee allows lenders to approve loans that they would not otherwise be able to make. And even for nonprofits, the SBA microloan program, for example, provides direct loans and grants to eligible nonprofit microlenders to make loans up to $50,000. So this is what I was really looking forward to getting into, is the 5 C's of credit, and being a guarantor for any type of lending product that banks offer. So typically anyone with 20% or more ownership in the business would have to be a guarantor. And because you're a guarantor, most, if not all other banks, they're going to pull your personal credit as well as the business credit. Because again, personally guaranteeing a loan is just that, it's personal. So even though it's for the business, they're going to pull your personal credit as well. So the 5 C's are capacity, collateral, credit history, conditions, and character. So getting into capacity, lenders pretty much must be sure that the borrower has the ability to repay the loan based on the proposed amount and terms. So they look at the capacity to borrow. Capacity is also determined by analyzing the number and amount of debt obligations that you currently have outstanding compared to the amount of income or revenue expected to pay each month. So they're looking at both sides of the business as well as any other debt you may have out there. Going into conditions. Conditions refer to the terms pretty much of the loan itself, as well as any economic conditions that might affect the borrower. So business lenders, we review conditions such as the strength or weakness of the overall economy, believe it or not, and the purpose of the loan. So one of the few of the examples I used, financing for working capital or equipment are common reasons listed on business loan applications. So while this criterion tends to apply more to corporate applicants, individual borrowers are also analyzed again for their financial reasons for taking on debt. Character, which is huge, it really refers to a borrower's reputation or record regarding financial matters. The past behaviors is the best predictor of future behaviors. That's what I'm trying to say. So we're looking at that credit history to again make sure that one of the categories is to make sure that you can make those future payments based on how your past history looks per se. Collateral, another C. It's personal assets pledged by a borrower, or business assets, of course. Like I said, and the one of the examples I use is if you're purchasing a piece of equipment, and we provide you lending to purchase it, that piece of equipment will be the collateral, for example. So if for some reason we did not get repayment, that would come to the bank, which is a last resort, of course. What was the other one? I think there was talked about capacity. We looked at capital as well. Capital, which is not listed in here, but it's really lenders. They analyze a borrower's capital level when determining credit worthiness. So capital for a business loan application consists of, personal investment into the firm, retained earnings, and other assets controlled by the business owner. And so best practices for strong business credit. Some of this may be self-explanatory, but I have these conversations on a daily basis, and it's really maintaining healthy credit. So obviously paying your loans on time, bills, and taxes as well. Make sure your business is visible. Maintain good relationships with suppliers and vendors. Separate personal and business finances. And then, of course, monitor your personal and business credit histories. I've had a lot of people ask me, how do they check their business credit? If you're taking notes, you want to write this down. It's called DUNN, D-U-N-N. and Bradstreet, you would be able to go on, I believe there is a fee, but if you go to their website, you'll be able to see how your business credit is, if it's been established long enough. And really, the only other thing I wanted to discuss is, I like to have this conversation up front with people who may be looking for lending down the line, and it's really just the financials and supporting docs that are needed as it relates to lending requests. So you want to definitely have a personal financial statement. If you've been in business long enough, we'll want to see 3 years personal and 3 years business federal tax returns with all schedules for all owners of or guarantors who are in the business who own 20% or more. Typically want to see a balance sheet and profit and loss for the business. Some businesses, if you have accounts receivables or accounts payables, we'll want to see that as well, because that's showing cash flow. And if you're less than 3 years, that's fine. I work with startup businesses, and as well as I'm sure many other banks do. But if you're less than 3 years, you definitely want to have a business plan in place. And that's really, I know that I direct a lot of people to SCORE for that reason. But a business plan, we're going to want to see 3 years of projections for the business. Typically, we want to see the first year broken down monthly, and then the second and third year broken down quarterly. So that's really what we're looking for as it relates to financials and supporting docs. And that's really all I have today, believe it or not. I'd love to talk offline if you don't have any questions, that you want to maybe put on the Q&A. But I am now open to questions.
Thanks, Stephen. We do have some questions in the Q&A box, and while people are preparing additional questions, I wrote down several. So the first question is, when you talked about installment loans, in general, what percentage of the equipment purchase price would you finance versus expect people to pay in cash themselves?
Great question. Thank you. Typically, we do 75 to 80% of the value of the loan. And I'm glad you mentioned that, because if it's a term loan and you don't, I'll give you an example, and you don't bank with Liberty, we're going to want to see those bank statements to show that you have that 20% kind of skin in the game for us to even entertain it. Great question.
And would you generally base it on the purchase price or an appraised value?
Purchase price. So if it's a piece of equipment or even a piece of real estate, we would want to see either a letter of intent or a purchase and sales agreement to know exactly what 75% or 80% of that amount would be for the request. Good question.
Great. And my next question relates to lines of credit. Generally, what are they secured by? And also, how does the interest rate compare to the interest on credit cards?
Great question. We actually have a lot of people consolidate debt with a line of credit because the interest rate is just so much better than a credit card. But typically we look at prime, which kind of the feds determine. The prime rate right now is 8.5, and usually it'll be 1% or 2% higher than that, depending on credit characteristics. But if you look at, an example of 9.5% compared to, what our credit cards now, around 28% or so, it's a big difference.
So a commercial credit card has a similar interest rate as a personal credit card?
Yes. Yep. Very similar.
So really, unless they're going to pay it off every month, it's a very expensive way to go
It is.
compared to a line of credit.
Indeed. Yep.
What are the challenges? Is it harder to get a line of credit than it is to get a credit card?
No, just because we're still looking at personal credit and depending on, where you're located, we have special programs in place in low to moderate income areas. But no, typically we're pulling personal credit because whether it's a line of credit, a term loan, or a credit card, you're still the guarantor.
So the line of credit, can it be secured by current assets like accounts receivable and inventory, or is it only secured by your personal guarantee?
Nope. We banks offer traditional lines of credit where it's just secured by all business assets. And really all that does is if you go to the Secretary of State website, it's going to show that you have lending through a certain bank. But real estate, equipment, cash, of course, and like you mentioned, Kathleen, receivables are probably the most popular collateral examples. But there are some where, the bank just lists all business assets and, kind of put that notice on the Secretary of State website.
Okay. We have some questions from our participants.
Excellent.
Mary asks, is there any advantage to getting a bank loan over using savings if you have them?
Yeah, I tell people this all the time, use the bank's money. Don't exhaust what you may have liquid. Just because it gives you more flexibility as it relates to maybe options that you may have for those savings. Whether it's getting a better rate of return and not exhausting everything. So yes, the advantage, I always recommend using the bank's money as opposed to, using what you may have liquid and possibly investing that in other sources.
The same person asks, what if the loan is not for purchase of an asset that can be used as security? For example, if you're not buying a piece of machinery, but want to use the loan to buy services like website design or marketing and branding?
Great question. That's more of a short-term need. So that would be more for a line of credit as opposed to a term loan.
All right. Now this person has a new company who is going to be selling solar equipment via e-commerce and other sales channels. And he's just about to launch this startup and he needs cash for working capital. How could he borrow without securing his home? And what kind of benefit is it to borrow using the SBA guarantee versus direct bank lending?
Well, the SBA guarantee, and I do know, I want to say probably since COVID, there's typically fees associated with it, but they waive those fees, and I haven't seen those come back yet. So that's really more for the bank to work with the SBA, because especially with this, like I mentioned, especially with the startup, it's tough because we don't have financials, past financials. So we have to really analyze that business plan and obviously look at your credit. But we 10 times out of 10, we would have to get the SBA involved for something like that.
And when people give a personal guarantee, are they specifically pledging their home? Are they implicitly pledging their home? What is the personal guarantee?
Yeah, in most cases, for startups with the SBA, real estate does get involved. Now, I've also had folks who, not necessarily on the business side, but it may be an easier process for them that if they are homeowners, again, not talking about anything on the business side now, but they'll take advantage of like a home equity line of credit on the personal side and utilize that toward the business.
Are there any kind of general limits that you can share for a company like this that would be extended, or is that every single one unique?
Every single one is very unique. And again, a lot of that is, and this is why I recommend SCORE all the time, because some folks I've seen, they'll get a template off the website and just kind of fill it in, those projections, and it really, really doesn't make sense, where, I'm referring them to SCORE, where obviously SCORE has that experience and expertise to make it make sense.
Mm-hmm.
So, Stephen, that kind of leads to a question that I've got. I was thinking about this, and we talked in Tuesday's class about your projections, and I capitalized the word reasonable,
Mm-hmm.
ensuring that they're reasonable, achievable, but reasonable. One of the things I was thinking about, we get this from time to time from clients who say, "Well, I don't have a history. I'm just a startup, so I don't have past financials that I can share." You mentioned the business plan would be something that you would lean heavily on, and recognizing that I liked how you said a 3-year financial projection at a minimum, monthly year 1, quarterly years 2 and 3. What are the other key aspects of the business plan that you would focus in on? Is it strategy? Is it the marketing strategy? Is it the differentiation strategy, the competition? Does it vary by a product business or a service business? What are those kind of key components of a business plan you would focus in on?
Definitely the marketing aspect of it, but what I've seen a lot of business plans where it's not included, and I totally recommend it, is a resume, believe it or not. Just because, it makes the case a lot stronger if you have experience. I've seen some folks, and I'll just give an example, they've worked at a bank and now they want to start their own restaurant, and they don't have any experience in doing that. It makes the request a little tougher, as opposed to, we're looking at your resume and you've been doing it for 10 years, for example. So definitely marketing strategy, obviously the projections, what your executive summary looks like, and resume.
That's interesting. I wouldn't have thought of that, but it makes sense now that you say it.
Definitely.
Wow. Okay. So if you're doing something similar to what you've done before, but now you're going to do it for yourself,
That helps.
that's more powerful. Like if you managed 5 restaurants and now you want to run your own, it's a different
Exactly.
story.
Exactly. Great example. Yep.
Okay.
Yep.
Steve, do you have more?
Not right now.
Okay. We have another one that's saying, what is the interest rate on a small business loan? I know that's a somewhat generic question, so maybe we could make it, you already talked a little bit about lines of credit.
Mm-hmm.
And I think you said they tend to be prime plus something.
Yeah, prime plus 1, prime plus 2, depending on credit characteristics. So for example, right now, on average, 9%, 9.5%.
And so when you say that it's prime plus 1 or prime plus 2, does it float with prime
Yes.
for every
Line-
month, or is it locked for a certain period of time and then it changes?
Great question. So for term loans, it's fixed. It's not going to change for the life of the loan. Whereas a line of credit, and this is with all lines of credit, whether it's a credit card or a traditional line of credit that I'm specifically referring to now, it's variable. So using my example of when the Feds meet and they discuss interest rates and what the prime rate is going to be. So, prime is 8.5 right now, and they meet tomorrow and decide to lower the prime rate to 5%. Your rate would change the following month to whatever they determined it's going to be.
And so if it's a term loan, do you still basically base them on prime? And is it similar interest rate to a line of credit? It's just that it doesn't fluctuate?
Correct. Correct.
So it would still be in the prime plus 1 to prime plus 2 range.
Mm-hmm. Yep.
If you put more down and you financed a lower percent, would the rate go down?
Yes, and that's taken into consideration, but I think more importantly, we always take relationships as a whole into consideration. Where, if you bank with us and you're fully committed, your banking relationship with us, we look at that, and obviously exceptions can be made.
Hey, Stephen, one of
And,
the things that
oh,
I'm
go
sorry,
ahead,
Kathleen.
Steve.
I was going to say this may be a little bit different direction, but one of the things that we talk to our clients about sometimes is keeping a relationship with their banker.
Mhm.
And you may take out a loan or you may get access to a line of credit. I guess, can you talk about from your experience, is this something that you do or folks on your teams do where they're frequently interacting with their clients? How often? What are the typical things that they like to be notified about in terms of working with their business clients?
And this is kind of going back to my example of how I work with, other lines of businesses within the bank. Just because even though I focus on lending, especially when folks have a full relationship, they may have a money market with us where they're getting, a certain rate of return on what they have in their savings. And they want to know, for example, if the rates change, because they're not monitoring that too much. And if they don't know the rate change from 6% down to 2% and it's still sitting there, they'll want to have a heads up on maybe another vehicle they can put their deposits into, get a better return. So I make sure that I personally emphasize to my clients, don't call the 800 number, don't go into the branch. If you don't call me directly on my work cell phone, even if it's not anything on the lending side, and I'll work with my line of business partner depending on, what they're looking to do to get it done. So I try to check in if I don't hear from my clients at least on a quarterly basis.
That's great. That's great advice.
Yeah, because what's crossing my mind is, given that we're in a high interest rate environment right now, if somebody were to take out a term loan that's fixed, it's going to be on the high side. And so if a year and a half from now the rates come down, they would potentially want to refinance that
Refinance.
at a lower rate and not just pay it out, wait to the end, just
See it
like
all
you
the
would with
time.
your mortgage.
Yeah, I've had some folks who, they had to get the lending right away, or they were going to lose the purchase of their truck or their piece of equipment, whatever the case is, and they'll get it, and then to your point, Kathleen, they'll refinance down the line and the rates get better, but at least they secured what they were looking to secure.
Yeah. Kurt asks if co-signers can be used if needed due to weak or poor personal credit.
Not really on the personal side. I mean, on the business side. I've seen it on the personal side, but really the only people who can apply, going back to the 20% or more ownership, would be the only ones who could really apply. But if you're 20% or more, it's required that you apply, and they do look at the lower of the two scores if there's more than one guarantor. But there's tools and services and products in place to, if your personal credit isn't there for some reason or another, like a secured card, for example. And what a secured card is you're putting money in the bank, and we're putting a hold on that money in the bank, and we're in turn giving you a secured credit card. And once you get that, you treat it like any other credit card. It gets reported to the credit bureaus when you're paying it on time. And I've seen credit scores go up in 3 months, 4 months. So there's tools in place, but going back, anyone with 20% or more has to apply, and they do look at the lower of the two scores.
Are there any types of business that banks tend to steer away from, perceiving them as too risky?
The only one that I come across all the time is marijuana. Just because even though in some states it's legal, like Connecticut, banks are federal. So we got to kind of base it on federal and not state by state. But outside of that, I've worked with all different types of industries at all different types of revenues and cash flows. So that's really the only thing that comes to mind for me.
Right,
And
because
I
if
used to
you're
work in banking,
Hmm.
and I worked for a large international bank,
Hmm.
and they were much more discriminating than smaller community local banks are, because they steered away from anything that might potentially damage them in the media or reputational risk.
Hmm.
And so, for example, it was not easy to lend to hospitals unless it was really strong, because if the hospital did something and got sued by patients,
Hmm.
things like that, or things that were considered controversial, they would try to steer away from. So it's easier when you're working on a personal level with someone like Steven than it is with some nameless, faceless 1-800 number, because they're going to be much more conservative than your local bank will be, because your local bank is going to get to know you and your character much more than anybody that's a big, huge behemoth would attempt to do.
Big time.
Yeah, and I have to imagine, Stephen, that if you have a business that applies for a loan and maybe it's in an industry or maybe their history, it may have a perceived risk that might be higher than another type of business. Um, might that skew not only your decision to approve or not a loan, but also how much you're going to allow them to borrow and maybe at what interest rate you would lend at? Is that factor into it?
Yes, it does. Not necessarily the interest rate, but definitely the amounts.
Okay.
Um, but that's one of the things, going back to what both of you guys were saying, just a smaller community bank with local decision making and, where exceptions can be made and cases can be made.
Because you must look at the failure rate for certain types of business, and that must factor into your decision in some way, I would think.
Yeah. But this kind of goes back to the where if it's kind of on that line to where we're not too sure, that's kind of going back to where we may bring the SBA in, for example, just to take that little bit of risk that we see off of the
Mhm.
bank.
I guess while we're on that topic, can you talk a little bit about the relationship between the SBA and lenders and how business owners should think about that? Should they go through the SBA? Should they work directly with the lender first? How should they think about that?
Yeah, at Liberty Bank, unless it's again just less than a year, for example, where we definitely got to get them involved, um, go to the bank first. And our underwriting department, for example, at Liberty Bank will determine whether we have to get the SBA involved, because there may not have to. But some banks, such as Liberty Bank, we actually have an internal SBA rep. So again, just going back to the local decision making and quick turnaround time, if we do have to get the SBA involved, we have that in-house person to get a decision made.
We have one more question in the Q&A box. Well, there's another one. Is it better to go with a local bank, national large banks, or new internet banks for startup business loans with the SBA? And then there's a second part to that question, but I'll hold it for now.
From my experience, again, I've been in banking 15 plus years. I've worked at 3 different institutions. And from my personal experience, it's a local bank. One, just going back to what I mentioned, local decision making. 2, you're not dealing with somebody out in Texas, for example. I'm your go-to person, local, and can meet with you anytime. Um, and I've just seen from my experience, and Kathleen, you touched on it a little bit. Um, the larger banks may not want to deal with a small business. I believe it or not, have seen that. They just want to deal with the big corporations because they may feel like it's not worth their time, for example. And then again, the new internet banks, going back to reiterating what I said, you you don't have that go-to person. And internet banks obviously are internet banks, so there's no brick and mortars where if you do have to stop into a branch, for example. So to answer the question, definitely a local community bank.
And then the second part of the question is it true that even though the SBA has a small down payment requirement, a lending bank may ask for a higher down payment?
So it sounds like we're talking just more in regards to a term loan and going back to that 75–80% to put down, I'm assuming. And I haven't seen where institutions ask, it's still typically that 75–80%. Although when I've gotten the SBA involved to where borrowers only had to put 10% down as opposed to, 20%. So yeah, it sounds like that's more along the lines of a term loan, but the SBA would not require a higher down payment. If anything, it's going to be lower.
Okay. Stacy asks, can you talk about any options to set up a display table at bank branches to advertise your business?
Do it all the time. If you have a relationship, and I'm sure other banks do too, because previous institutions where I worked done it, but we call it our business spotlight. And typically for a month, maybe longer if there's not a client that's on for the next month. But to answer your question, yes, we call it our business spotlight, set up a table, marketing materials, contact information, you name it. And we do that for all of our clients who bank with us.
That's fantastic. I saw that question and I thought, oh, they probably don't allow this.
I
Oh, yeah.
know, me too.
That's a great
Definitely.
surprise.
Definitely.
I'm shocked.
And obviously it's free marketing. You're getting foot traffic from, other clients of the bank who sees it, and it's a good way to market for free.
Wow. And is it all the branches or one in particular, or how does that work?
Every single one.
Wow.
Yep.
You said it was called Business Spotlight?
We call it our business spotlight. Yep. Great for free marketing.
In general, what kind of credit score are banks looking for? Or can a strong business plan or strong past spreadsheets of finances override a credit score?
No, not necessarily. Banks typically look 660 through 680 minimum. But I also mentioned, depending on where your business is, we have low to income footprints within the bank, to where, your credit score can be a little less based on that program if your business is in that footprint. But Steve, obviously you're familiar, but we also have what's called our Small Business Academy, where if you complete the academy, it's a 10 courses you'd have to take. But once you completed those courses, we would give you a $5,000 line of credit, as long as your credit score was 600 or more. So there's different programs and different options that I always sit down to provide more insight to my clients on the different options that they can take advantage of to get funding either now or down the line, depending on the situation.
So what you just described, Stephen, was by taking that, the credit score can be slightly lower than you would normally expect.
Correct.
And still get the line of credit.
Correct.
Okay. Somebody asked a question just about that. How about classes offered to new business, and at the end they have an option to apply for a business line of credit?
It's exactly what I was referring to. So if you were to just go to Liberty make sure you put the dash, liberty-bank.com, and you can search Small Business Academy. It'll provide you insight on the different types of classes that you'll take during those 10 courses, as well as, next steps once it's completed to get a line of credit.
And the last question we have right now is, what state or city is your bank based in?
We are headquartered in Middletown, Connecticut. We cover all of Connecticut and Western Mass. We're actually the largest mutual bank in America. And what that means is we're not owned by shareholders. We're owned by our customers. So one, we can't be acquired by eaten up by those larger banks. And yeah, and it just provides us more opportunity to offer the right products and services and give back to the community.
That's great. So we still have a few minutes left for some additional questions. So feel free to add those into the Q&A box. And while we still have a few minutes, I'm going to launch a second poll here. If you are interested in working with a SCORE mentor, if you would like to work with a SCORE mentor, you can answer yes to question number 2, and you will receive an email from me. I'm just giving you instructions on how to do that. That'll be the only email you receive from me. I will not be spamming you. Don't need to worry about that. And if you're not interested in working with a SCORE mentor, that's fine as well. We just wanted to offer this helpful advice at the end of the webinar, but we still have a few minutes left for any other questions.
I don't think if I had any more.
I don't think I had any more either. I think this was very very informative. We do have a question in from Stacy, who asked, I might have missed this. Is there any way to build credit quickly for the business? Stephen, you're on mute.
Sorry about that. Yeah, I recommend, even though we talked about interest rates being a lot higher, but starting with a business credit card.
And paying it off.
And paying it off.
Yep.
So then basically, if you're doing that, you're only paying the fee for the card, and you're building your credit history as a business.
Exactly. Yep.
Mm-hmm.
And then for folks who might be underneath that kind of minimum that Liberty Bank is looking for, are there like repair tools, repair classes, services that Liberty Bank offers and works with folks on?
Yeah. So in addition to like I mentioned, the secured card, that's always what I recommend. Just because it's going to help we're gonna pull your personal credit. So if your personal credit isn't there, we need to start with that. But I can provide a link, Steve, maybe that you can send out later on.
Sure.
We do offer other types of credit repair sources. But I always recommend if your personal credit score isn't there, get a secured card. It's gonna boost your credit. Again, I saw people's credit go up in 2-3 months. So don't wait if you need to. That's one of the options, and I'll send Steve some more info that he can send out to everyone.
Great.
So if you have cash, but you don't have good credit, it's a really good way to go, is what you're saying, because you're collateralizing the card, so it reduces the risk to the bank.
Exactly.
You're building a credit history for your business before you've got a significant enough history of the business's financials to warrant a loan.
Well, no, the secured is more on the personal side.
Got it. Okay.
That's on the personal side, but we look more at personal credit than business credit, especially for startups who may not even have any business credit yet. But no, the secured card is on the personal side. So, if you're 20% or more, we're going to pull your credit through TransUnion. We're going to start with that right away. So, and a lot of people ask me, why are you pulling my personal credit? And it's for the business, but it's because you're a guarantor.
Mhm.
And, going back to the credit characteristics and history, we want to make sure that the guarantor is guaranteeing payment. And if your credit's not there due to something that may have happened in the past, underwriting is going to take that into consideration. So yeah, the secure card is on the personal side.
Okay, that makes sense. The same person asked, do I need to go to a bank to do a secure credit card, or can I do this online?
You would have to go to a bank. The reason being is it's just the process of setting up that savings account and putting a hold on it, and then providing you with that secured card. So yeah, that's something you can do an unsecured card online, but not a secured card, not yet at least.
All right, and then we have a question for us, Steve. At the end of this series, will you talk about which options are more suitable in a particular case?
Of course.
Yeah, I think that's on Kathleen and me, I think, at the end of our 4-part series. It's a great suggestion, Mary. We'll put our heads together and think through that for our last class next Thursday.
That's a good idea.
It is going to somewhat depend on each individual case.
Right.
So we will do our best to come up with some generic suggestions, but it is going to be a little bit tricky to do that.
Yeah. We'll think through that. All right. Last call for any questions before we wrap up here today. All right, we're not seeing anything today, or for today's questions anyway. All right, with that, we're going to wrap up our recording. I want to thank everybody for joining today. I hope you enjoyed our seminar. Stephen, thank you very much for providing your expertise. This was wonderful. If you haven't attended, or if you are interested in attending our classes next week, please do so at score.org. You will also receive a link to sign up for those tomorrow. And if you are watching this on our YouTube channel, be sure to check out all the other videos that we have on our YouTube channel and subscribe so you can be notified whenever we put up a new webinar. So with that, I think we will stop the recording and enjoy the rest of your day, everybody.
Thank you.